Hi, I'm CKE. Welcome to my Cybercode special. Now, with COVID-19, a new reality has emerged. New economy stock has performed well, particularly those related to medical, technology, and logistics. However, certain market principles remain unchanged and still helpful in making sense of the market. Now, many retail investors actually make things overly complicating. They miss the obvious and the basic. So I'd like to give you an overview in as straightforward manner as possible and how you can approach the markets with better odds. Now let's begin. Now market comprises of buyer and seller. Buyer of stock, seller of stock, not product and services. These are totally different. Price is determined by the demand and supply. Now at any one point in time, demand and supply are always matched. We are not interested in that. We are interested in the pressure behind the demand, the pressure behind the supply. Now, if the buyers are more earnest than the seller, it bid up the price. If the seller are more earnest than the buyer, they sell down the price. Ultimately, end of the day, it's the imbalance between the demand and supply that cause the price to move. And all these are reflected in the charts. The chart shows what the smart money are doing. And it's important for us to constantly look at the charts. Now, take a look at this stocks Indofood. Price moved up. Why? Because the buyer are more earnest than the seller and they bid up the price. Same stock, Indofood, price went down. Why? Because the seller are more earnest than the buyer. Now here we have a chart of Gentings. Generally, demand and supply are balanced. Buyer and seller of equal strength. Price moves sideways with little price progression. So ultimately, end of the day, market is the aggregate of the perception and action of all the participants. Now, the perception could be based on technical, could be based on fundamental, it could be based on sentimentals. It doesn't really matter. What is important at the end of the day is the actions they took with their thinking. Markets is in the endless cycles and it continues to do so. Market is always in one of the following stages. Number 1, basing. Number 2, advance. Number 3, distributions. And number 4, decline. 4 stages. Now let's take a look at the pictorial representations. Now this is basing. Stage 2, advance. Stage 3, distribution. Stage 4, decline. And back to basing. Spring, summer, autumn, winter, and back to spring again. And the whole cycle will continue to repeat. Now never stay in 1 and 3. 1 and 3, we stay aside. Now stage 2, we go long. Stage 4, we sell short. Now, if you don't know how to sell short, stay cash. Now, let me give you an example. This is STL on the weekly charts. Now, stage 3, 2015, stage 4, stage 1, 2017, stage 2. Now, if you have bought the blue chips, you make money easily. 2018, that's stage 3, stage 4, stage 1, 2020, we have a sell down, stage 4. Now, somebody who will notice there's a blue line here. Now, this is a 40-week simple moving average. It's a very slow line. So it tells you the long-term directions of the markets. At this point in time, STI is just doing a counter trend, long-term downtrend. Now, let's take a look at an example of a stock. This is E-Zone. 2012, this is actually stage 1, stage 2 advance, stage 3 distributions, stage 4 decline. Now, stage 2, we go long, stage 4, we sell short. Now, if you don't know sell short, stay cash. Now, when the stock was at about $1, there was a lady who came to my office for help. Now, this lady has bought the stock at $2. Now, this chart is adjusted for right. So it's at the peak here, $2. Now, when she came to see me, she already lost 50%. Now, that's not the problem. The problem, she actually has 50 lot at $2. That's 100,000. So she lost 50,000 when she came to see me. They asked me for help and what should she do? Now, I told her there's only 2 options. Number 1, cut loss. Of course, it's extremely painful. $50,000 loss. Number 2, you sell short using CFD. Now, this lady wasn't sure about selling short. It appeared dangerous to her. And he doesn't know what is CFD. Now, I told her, selling short is not dangerous. It's not knowing what you're doing in the market that is dangerous. Now, she wanted to think about it. And before she left my office, she actually asked me, where do you think the stock price will move to? I look at the left side of the charts, there's a support at 20 cents. I said, likely to go to 20 cents. Now, they say, how can you be so sure? I said, the whole sector is going down. This is not the only stock. And sector strength has the greatest influence. Now, for those people who know the stock is eventually trade to 4 cents. The stocks has lost 96%, and this lady has lost 96,000. Now, this is not necessary. This is stage 4, you sell short. If you don't know how to sell short, stay cash. When you stay cash, you can never lose money. This is Sabana REITs. This is stage 1, this is stage 2, this is stage 3, and this is stage 4 and stage 1. Again, stage 2, we go long, stage 4, we sell short. Yet during this period, a lot of people complain to SGX about the REITs manager being incompetent, buying property, paying more than necessary. Now, there's no need to complain because that stage 4 is to be selling short, making money selling short. So among those that actually invested during the times are people highly intelligent and yet they still lose money. Now, for those people known, eventually the stock went even further down. Let's take a look. Maple Commercial. Now, I purposely highlight these stocks because a lot of retirees tend to invest in REITs for the dividend yield so they can live on it. But unfortunately, without understanding the market cycle, they can actually lose a lot of money. Now, this is stage 1, going sideways, stage 2, and stage 3, distribution, and stage 4. And right now, the stock is just struggling below the 40 weeks. Now, there are better REITs to participate in. This is not the best stocks in the market right now for REITs. This is Dow Jones Industrial Index. A lot of people will be watching this index. Now, this is stage 4, subprime crisis. This is stage 1. Now, if you look at the subprime crisis in hindsight, this appeared to be a speed bump. Now, this is stage 2. Went sideways, continue stage 2. And over here, we have stage 3 and stage 4, the sell down. Now, I'd like to actually open up this for you to see in the next slide. Now, I draw 2 lines. Now, this here is the value area. This is where the buyer and seller generally agreed that that is the fair value. Notice over here, the seller push it down, the buyer come in and mop it out and bring it back to the value area. And over here, the buyer push it up and the seller push it down back to the value area. Now notice during this period, there is a 1 week pause before you break this support, which is at 25,000. And then when this happened, the hell break loose, panic selling ensue. All right. And what happened was that the buyer come in and mop it up. Now this exactly happens because of liquidity in the market pumped in by the Federal Reserve and back to the value area. And right now, Dow Jones is slightly above the value area. Now we've got to watch because something like this may well happen. But January right now is positive. It is back to pre-COVID-19's time. Breaking this will be serious and need to watch. You will test the 18,500. So January, the US markets is a lot stronger, and right now they are back to pre-COVID period. This is an example of US stock. This is Boeing. Stage 2, gone sideways, continue stage 2. Stage 3, sell down stage 4. And this stock is struggling below here. Let's take a look at a very simple stock. This is Visa. It's a lot easier managing the stocks than Tesla, than Apple's. All right. Let's take a look, stage 1, stage 2, continue stage 2, you went down stage 3 and managed to recover stage 2. So this is just a sample of stocks, whether it's Singapore, Malaysia, Hong Kong, or US. You can do the same by looking at these 4 stages. Important right now is how to position yourself for profit. Ask yourself this question: is your investment backed by a sound strategy? Now, it's a known fact, majority of investors actually lose money over time, 95% of them. All right, the bottom 50% is consistent loser. The next 40, 45 make some money, lose some money, and at the end, nothing much to show. Only the top 10, top 5% are consistent winner. Now, perhaps we think they're professionals who have done better. Unit trust, in America, they call it mutual fund. Now, it's a known fact, 75% of fund cannot be S&P 500. And this has been actually observed over the years. Majority of the active fund cannot beat S&P 500. Now let's take a look at MESA. MESA is a society for the top 2% of the populations, those with extremely high IQ. Now in the period that tracks the S&P 500 over the 15-year period, the returns is 15.3. Now MESA has an investment club. And over the 15-year period, the return is quite pathetic. It's only 2.5. Now from here, and this was repeated in many observations and studies, intelligence is not a requirement for investment success. Right? In fact, if your IQ is very high, it's probably a hindrance. Now let's take a look at a passage from the book which I extract from by Mark Douglas. Now, for those of you who do not know Mark Douglas is an expert in trading psychology. And in his book, which I extracted, the largest group of consistent losers is composed primarily of doctors, lawyers, engineers, scientists, CEO, wealthy, retiree, and entrepreneur. Now, if you think about it, these are people in the top echelon of our society, and yet all these people cannot make money from the market. Doctors will include dentists, lawyers, engineers, all sort of engineers, all sort of scientists, CEO, CFO, CEO. Most of them are accountancy trained. Wealthy, retiree, and entrepreneur, Fortune 500, and startup, all the same. They all lose money, consistent loser. Now, the wealthy retiree, what do? They invest in stock like Brumon. This is from newspaper. Reported client losing some anywhere from 20,000 to 300,000. Certainly, these are wealthy retiree. They went on to do things like oil bunkering and lost money, mini bonds, offshore marine bonds, and most of these bonds defaulted. Binary options, and more recently, cryptocurrency. Now, the latest been high flux perpetual security and preference shares. Now, it's reported that 34,000 investors own a total of 900 millions. Now, this is uncalled for if you understand the market cycle. Stage 4, you do not buy, you only sell short. If you don't want to sell short, stay cash. You cannot lose money holding cash. So 95% actually lose money, and many of them are intelligent people. Now let's take a look at these pie charts. Let's assume that this pie chart represents the populations of investors in the markets. Now the blue portion here constitute the retail investors, about 10 to 80%. The rest are institution. Now 5% of the retail investors make money, and 5% of the institution make money. Now if you are 5% investor here, they make money. Where do you make money from? Think about it. Now, you don't make money from the retail. They are just too small. You make money from the institution, lost money. And it's a fact that majority of the fund underperform. That is the stark reality. So next, ask yourself these questions. What should we be looking at? What should we be focusing on? What should we do? Give you a clue. Take a look at this image. What does it convey to you? Focus on momentum. Now, whatever I share with you will complement what you're currently doing. You don't have to throw away those things you have learned, those things you have read. You don't have to throw them away, but it will complement what you're currently doing. Now, why momentum work? And object emotions tend to stay emotions. Now, when a fund manager buy stocks of a company, they do not buy one time. They continue to accumulate. They continue to mine. And that causes the stock price to continue to move. Next, stock tend to move in the line of least resistance. It is just like a car. It's easy for the car to continue to move forward than to stop and reverse. Now, this is important. Now, before there is a change in price, there must be a change in momentum. Now, we are all interested in a change in price, net advance in price. But before there's a change in price, there must be a change in momentum. And that gave me a clue. Take a look at Costa. Stock move up 8,000% in 4.5 years. Momentum work. This is Tencent. A lot of people familiar with this company. Stock went up 3,000%. And it continued to make new high. This is AEM. Again, a lot of people familiar with these stocks. From 2017 to 2018 itself, it actually moved up 800%. And this stock again continued to make new high. This is Eagle Hospitality. Again, momentum work, whether up or down. Positive momentum with long, negative momentum with short. Let's continue. There's a natural bias to strong stocks. Now, when the institutions acquire the stocks of a company, what are they looking at? They're looking at earning. Basically, they are looking at earning momentum. They're more interested in futures earning, not current earning. They want the future earning to be better than current earning, all right? And the technical trader, likewise, they are interested in momentum. They're interested in price momentum. So you notice a lot of traders are looking into momentums. Now you find it difficult to understand. Let me give you a very simple analogy. Now, if you happen to be in a hawker center, which you have never been before, and you're looking for good food, what would you do? You're in a hawker center which has never been before, and you're looking for good food. What would you do? Now, the obvious answer is to look at the longest queue. Now, if the longest queue happens to be the food you like, in this case, fish soup, you queue. If you do not like, look for the second longest queue. Very likely, you end up having good food. Now, once you have finished your food, there are 100 stores here. You can go and interview all the storeholder. Where is the recipes from? Where you get your ingredient? How you make your sauce? Whatever. This is called fundamental analysis. Now, I'm not against people doing fundamental analysis, but it's just that you have to understand we do not have enough resources to do all the fundamental resources like the fund, all right, like the institution. They have all the resources. But what happened was that we can see what they do with their research, what they do with their analysis. And that is all reflected in the charts. And that's the reason why it's important for us to look at the charts. Let's continue. Participate in the stronger sectors at different parts of the economic cycle. Now, for those people who invest in the market long enough, you understand actually markets actually move according to the sectors. The sector will rotate during economic cycle. Early part of bull market, usually a financial stock will perform, followed by industrial, followed by transports, and then the defensive stocks. And they continue to repeat. Now, if you are able to actually find the strongest stocks in the strongest sectors, you get highest return in the shortest time. And momentum help you to achieve that. Let's continue. Now, focusing on momentums help you to be flexible and well-balanced because you can long, you can short. Again, if you do not know how to short, stay cash. Stay away from wrong side of the market. Positive momentum, we are long. Negative momentum, we are short. So you are not at the wrong side of the market. Trader investor has the best of both. Why? By looking at the momentum itself, you actually trade short-term, mid-term, or long-term. Now, focusing on momentums, how us to capture the explosive move in stocks. So for us, if you're interested in explosive moves, it's important to actually look at momentum. Trading on momentums. Now, explosive swing trading methods give you the best of capitalizing on momentums. Why is it so? Because you take advantage of a short-term move created by the smart money. Now, the institutions do not jump in and out every other day. They are slow. But retail investor can take advantage of the movement created by the smart money. Does not test your patience. Stocks are usually held 2 to 5 days, sometimes 10 to 20 days, which is about a month. Now, in today's context, a lot of people may not have patience. No fault of yours because we are just have too many things distracting us, especially from social media, from Facebooks, from your emails, from the internet. So most people may not have necessary patience. Using swing technique help you to actually mitigate this problem. Avoid falling in love with the story which cause you to suffer big losses. Now, if you understand the positive momentum and negative momentums, and you understand that for swing trading, our horizon is about a month, you're not likely to fall in love with the story, and which actually cause you to suffer severe losses. If versatile, it's tradable on multiple time frame. You can trade short-term, mid-term, or long-term. Now, having said this, swing technique itself is applicable, and you can trade on weekly charts. And they allow you to actually trade on the longer term if that suits your lifestyle and personality. So one strategy allows you to actually trade in different time frames that give you a lot of advantage. How are we going to approach that? Reaction swing, momentum swing. So I have 2 different approaches to doing swing trading. And remember, you can do it at short term, mid term, or long term. Now, if you want to know more, you can actually scan this QR code and find out our Mastering Explosive Swing program. Now, you can also subscribe to our YouTube channels And I'm most happy to see you in my next Cybercode special. Thank you for listening.